All right. Today is Monday, October 18th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight because we're about to dive in a wealth of information. And here it is. In focus tonight, we're going to talk about Fed Chairman Jerome Powell, Mr. Dangerous, because he got caught again insider trading. And then we have more alarming data from China. And lastly, the breaking news we got after the bell, the SEC's report regarding the GameStop fiasco. We start by what else? Mr. Dangerous got caught again. He timed the top this time around this year, liquidated his assets along with his buddies Kaplan, Rosengren, and who knows who else. They dumped stock right at the top this year. And guess what? They also timed the top last year, according to a new report we got today. Fed's Powell sold up to $5 million in stock in 2020 before the market tanked. He sold exactly on October 1st, which was the market top. So here we go again with the corruption. We have the Fed Reserve Chairman and other Fed presidents timing the market, buying assets before they pump the market higher, and then dumping their assets or booking profits when the market is about to cool down. When we have seasonal tops, which, by the way, the Fed's policies also determine from time to time. And therefore, this is 100% insider trading, yet these criminals get away with it. Unscathed, no problems whatsoever. Media organizations are not reporting on this story. They never reported on Kaplan or Rosengren getting caught trading stocks using insider information. How could you trust the central bank of the world when we have Fed presidents and the Fed chairman himself, Mr. Dangerous, timing the market to enrich their own pockets? There's something more sinister here. They are gambling with the future economic prospects for the next generation and racking trillions and trillions and trillions of dollars in public debt. And oh, by the way, they're also creating a massive inflation problem here, impacting the poor and the middle class the most, while they get richer by timing the stock market. Is there any watchdog here? Of course not. Congress is already trading stocks using insider information. The Senate are also trading stocks using insider information. Perhaps the SEC itself. Wait till that can of worms come out. Perhaps they're also trading stocks using insider information. Everybody's doing it right now. There's no problem whatsoever, and it's business per usual. Cheating to get ahead. And then they say we did not violate any ethics rules. The ethics rules that we made for ourselves. The rules that we made. We did not violate any of these rules. What are you talking about? That's convenient, isn't it? Can you imagine if I rob a store, I get caught by the cops, and I say, you know what? According to my law and my rules, robbing a store between 3 and 4 p.m., that is not a crime. You think that'll fly? Perhaps in San Francisco, but not anywhere else. Yet these politicians and Fed officials violate the rules, use and abuse the rules to their favor, and we don't even get a media report. No media organization is reporting on this story. Not CNN, not ABC, not CBS, not Fox. Nobody's reporting on this story at all. This is a story that should be on the evening news in every major media corporation. Every American must be aware of what's going on at the Fed, Congress, and the Senate, with politicians and officials using insider information to trade stocks and options. Instead, we have to rely on articles in newspapers, not even front page articles, by the way. You have to look for them. And here's one of them from the Daily Beast. They call it the cheat sheet, the top 10 right now, and the number one story at the cheat sheet is Fed Chair Jerome Powell sold millions in stock as Dow tanked. What's going on here? Federal Reserve Chair Jerome Powell sold between $1 million and $5 million worth of stock from his personal account as the COVID-19 pandemic ravaged the U.S., according to the American Prospect. And although top Fed officials who have privileged knowledge of the economy's inner workings are not required to put their assets into a blind trust while serving, two other Fed honchos were forced into early retirement after disclosing their own trades last month. Isn't this a problem, by the way? They're not required to place their assets in a blind trust. This is the best job of all time. You get to manipulate the market, and you know exactly when to buy and when to sell. Powell's big stock sale occurred on October 1st, 2020. The Dow would tumble 1,600 points that month, the worst month since the beginning of the pandemic. The Dow made up its losses in the period to follow. And I'm pretty sure that Powell bought the dip. But anyhow, Powell's latest financial disclosure statement puts his personal wealth in the range between $20 $155 million. Here's another problem. Why are we choosing multimillionaires, ex-Goldman Sachs, ex-BlackRock, ex-Blackstone to lead the Fed? Isn't this a problem to begin with? How about choosing somebody who has the public's interest in mind, not their own personal wealth? And of course, the main question right now for the economy and the market, will Jerome Powell serve another term? Will he be renominated by President Biden? Well, for now, we have Republican senators endorsing Jerome Powell for another term, of course. They want Powell to continue to print money out of thin air to make the rich donors richer and richer and richer. But we have massive opposition here from the other side. We know Elizabeth Warren called Powell to his face and told him she's not going to vote for him when the renomination vote hits the floor of the Senate. And while perhaps Warren could rally some of her allies to vote against Powell, the final decision remains at the hands of President Biden. Will Biden renew the tenure of Jerome Powell, the tyrannic tenure of Jerome Powell, or will he finally wake up and realize that Jerome Powell is his biggest political enemy right now? This massive inflation will not wane down anytime soon. The massive log jams that you're seeing at the ports at LA Long Beach will not be over till next year. This is of course assuming that we're not going to get more ships waiting to dock at the port. We know this is impossible, of course, because the demand continues to be stalked higher and higher and higher. So this supply chain problem at the ports will only get bigger and bigger and bigger. Of course, the administration will hold the blame for this inflation problem, while we know who gave birth to this inflation problem. It is the reckless monetary policy led by Fed Chairman Jerome Powell. According to the article, the critics of Powell are not arguing against his policy regarding interest rates or the monetary policy for that matter, rather than another vital function of the Fed, supervising banks. This is, of course, the concern for Senator Warren, who sits at the Senate Banking Committee and one of Powell's most outspoken critics. She accuses him of watering down the banking regulations that Congress adopted after the financial crisis. Senator Warren said, "Over and over, you have acted to make our banking system less safe." She told him right to his stupid face. And that makes you a dangerous man to head up the Fed. Of course, the article says that the concerns are not regarding the monetary policy or interest rates. This is, of course, baloney. I consider myself one of the biggest Fed critics out there, and my main criticism is the reckless monetary policy of printing coke out of thin air and injecting the market every single month with billions of dollars to create asset bubbles in the equities and real estate markets. I am also criticizing the Fed's interest rates policies. With this massive inflation, tapering will not do the job, and interest rates must be lifted higher gradually, starting right now. The longer the Fed waits, the longer we're going to inch closer to a major Fed policy error, which will drive this economy into a massive inflation problem, the likes that we have not seen since the 1970s. Continuing with the article, we have more criticisms here for Fed Chairman Jerome Powell. Fed policymakers are preparing to gradually scale back the amount of money the central bank is pumping into the economy, but they don't want to move too quickly and see the recovery stall out. As chairman, Powell has steered the central bank toward a policy that is more committed to full employment, more committed to Wall Street, even if that means tolerating somewhat higher inflation in the short run. However, he has stressed that the Fed will use its tools, namely higher interest rates, to crack down if prices appear to be spiraling out of control. Prices are spiraling out of control right now, Mr. Powell. Are you going to use your tools? Of course not, because he knows that jacking interest rates higher will crash the stock market, and he's not going to do that unless he gets the green light, the permission, and the blessings from the ruling class, who will say, "Mr. Powell, we made enough money. It is time to pull the plug." It is doubtful that an alternative nominee would be any more aggressive when it comes to prompting jobs or keeping interest rates low. Again, this is all garbage. After trillions and trillions and trillions of dollars being printed from the Fed, we have yet to recover the jobs that we have lost since the pandemic started. Yet this garbage journalism says that the Fed is being aggressive in promoting jobs. What are you smoking here? Any policy differences are more likely to revolve around things like bank regulations and the Fed's role in battling Climate change. Wow. The future is bright, folks. Most recently, critics have also faulted Powell over allegations of unethical trading activity by other top Fed officials. The Wall Street Journal and Bloomberg reported last month that two regional Fed bank presidents, Kaplan and Rosengren, were actively trading stocks and other securities in 2020, while the Fed was heavily involved in financial markets. And we now know that Jerome Powell is one of those Fed presidents. It's not just the Fed president, excuse me. It's the Fed chairman himself also got caught trading stocks last year. In addition, Fed Vice Chairman Clarida sold bonds and bought stocks worth at least $1 million just days before the Fed announced an emergency rate cut. What a coincidence, huh? All three men plus one right now, who's Mr. Dangerous, you gotta add him to the three, have defended their trades as permissible under existing ethics rules. Yep, the ethics rules that you guys made up for yourselves, right? How convenient, by the way. But Powell has acknowledged those rules need tightening, and he has ordered a review of the trades by the central bank's inspector general. For all you know, the central bank's inspector general is also YOLOing stocks and trading options using insider information. And of course, when we look at the betting odds, whom will the Senate next confirm as chair of the Federal Reserve? The odds for Powell are dropping like a rock. And the next contender is Governor Braindead, but my money remains on Raphael Boystick. $20 that he will be the next Fed chairman. Moving on to the China story, we have more disturbing news regarding the Chinese economy. China's economy continues to slow, rattled by real estate and energy. The GDP growth was only 4.9%, and it shows the country's huge industrial sector has run into trouble, but exports and services are looking strong. Pay attention now. Internally, the Chinese economy is suffering and it's about to collapse. What's keeping the Chinese economy holding for now is the overseas demand. What does that mean? All the coke and the stimmies we printed here in the US, all of this is being translated into demand. Hyper demand, and therefore you're seeing it overwhelming the supply chain. We're having all of these port blockages, but it's also keeping the Chinese economy afloat for now. Why is that? Because we're importing all the goods from China. In all likelihood, though, you're not going to have an American economy that is thriving while the Chinese economy falling apart. China is too big to fail. More bad news from China. China's factory production hindered by power crunch in September, and this is a major problem, by the way. Energy prices continue to rise higher and higher and higher. What does that mean? We will see more shutdowns and interruptions in factory production in China. Coal prices are surging out of whack. Put two and two together, the massive demand from the U.S. consumer due to massive stimulus and printing programs, buying stuff from China. But Chinese factories are now slowing down. What does that mean? The supply chain is far behind the demand, and the demand continues to grow higher and higher and higher. The gap between supply and demand, this is what's causing inflation. And at some point, demand will spiral out of control, supply will struggle to catch up, prices go out of whack into hyperinflation territory, and that will crash the demand on its own. And therefore, you get two choices. If you are the Fed chairman right now, you either sit and watch till the demand organically blows up, and if that happens, we know from history that this is usually followed up by a massive recession, if not depression. You have another choice. You can pop the bubble manually and reduce the demand power in the economy via raising interest rates higher. If you start to do this right now, the inflation problem will be controllable. But we're running out of time. Of course, raising interest rates will come at a cost, which is destroying zombie companies and the stock market, because it is a coked up, zombified stock market. Hooked up on drugs. You remove the drugs, the market crashes. The Federal Reserve right now is 100% fixated with a tunnel vision like on the stock market. You can even see it in the FOMC minutes. They're so worried that the market might go down 10-20%. It's going to go down 10-20%, if not more. Anyways, Mr. Chairman, you have the choice and the will right now to pop the bubble manually, and this will save the economy and this country a massive inflation problem to come. We have more bad news from China. The lending growth is slowing down significantly. The yuan lending growth is the lowest since 2002. even though it's up 11.9% in September. This is a major slowdown in the Chinese economy. What about the Evergrande crisis? It's not over yet, we're just starting here, and is becoming extremely contagious to other property managers in China. Defaults loom over more property developers in China as China, reassures investors on Evergrande. The Chinese government says nothing is going on here, folks. Everything is normal. Don't worry about anything. Meanwhile, there's a mushroom cloud right behind them. All eyes will be on Chinese real estate developer Sinic Holdings, which warned last week it is not likely to repay offshore bonds worth $250 million due on Monday. This is today. We have more deadlines coming here. On Friday, another developer, China Properties Group, said it had defaulted on $226 million worth of notes. Here's the problem, folks, when it comes to China. It is what's hidden behind the scene. This is what we know. I'm concerned about what we don't know and what will catch us by surprise. Lastly, the breaking news we get after hours, the SEC's report on GameStop. Let's see what's going on here. The SEC describes the GameStop frenzy, but not what to do about it. A long-anticipated report did not suggest any policy changes in response to the meme stock frenzy that caused some little regarded shares to soar. You know, when the human civilization ends in about 80 years or so, we're going to look back at this article, for example, and we're going to read meme stock. What is that? That was the sign right there and then that civilization is about to collapse, and we did not see the signs. The frenzied trading in shares of GameStop and other so-called meme stocks last January led to big losses for some hedge funds, an outcry from retail investors who were suddenly shut out of buying, and calls on Capitol Hill to overhaul rules governing the markets. The long-awaited report from the Securities and Exchange Commission, the SEC, on the hyperbolic trading in shares of the struggling video game retailer and other stocks found that everything worked largely the way it was supposed to. Wow. The 45-page report released on Monday suggested no policy changes in response to the heavy trading in GameStop and other little-regarded shares that soared in value, thanks in part to posters on Reddit and Twitter, where many have gathered amid a pandemic boom in amateur trading. The report confirmed that the rapid price increases had been fueled in part by so-called short squeezes, as investors who bet against the stock, including hedge funds, had to quickly change course and buy the shares themselves to close out their positions, also known as short covering. Momentarily, it seemed small traders had upended the traditional balance of power on Wall Street. But as trading volume surged and prices soared, several brokers blocked individual investors from buying the shares of key meme stocks, reversing their rise. The halt prompted outrage among individual investors, a flurry of lawsuits, and a plethora of online theories suggesting that powerful Wall Street firms had forced trading to stop. The SEC's report instead pointed out that Robinhood and other platforms had halted trading in certain shares after the industry's run clearinghouse that settles most stock trades, a process that takes two additional business days, demanded nearly $7 billion from 36 clearinghouse members on January 27th, the peak of the frenzy. That demand, referred to as margin call, was meant to ensure that the stock trading system would survive, even if the growing risk associated with heavy trading in meme stocks caused the brokerage firm to collapse. To reduce the amount demanded, some platforms limited trading in those popular stocks. The clearinghouse's demand, the SEC found, reflected a market functioning normally, you think? Although it suggested that policymakers could consider ways to speed up the settlement of trades. About time, don't you think? It takes 2 days to settle a trade in the 21st century. Continuing with the article, speeding up the settlement trades, potentially reducing the impact of such margin calls in the future. While the report did not propose changes to the way the market functions, it did suggest that new rules may be necessary to address the so-called gamification of trading. So now they're blaming the gamification of trading, but the system is all wrong. I don't believe this garbage at all. You and I know that there are hedge funds sticking up to other hedge funds The hedge funds that happen to be short these names, GameStop, AMC, etc., they spark a trading frenzy using these platforms like Reddit, etc., and they buy calls aggressively so, and they make millions and millions and millions of dollars from destroying their rivals, other hedge funds that happen to be shorting the stock. And the conclusion of this report is the SEC woke up, they looked, they analyzed, they studied, they considered, and then after all of that, they went back to sleep, back into coma. Anyhow, folks, we have a great show for you here. Let's move on to the market's performance today. And here we go. The Dow Industrial Average closing in the red, down by 36.15 points, or a decline of 0.10%. The Nasdaq closing in the green by 124.47 points, or a gain of 0.84%. The S&P 500 also closing in the green by 15.9 points, or a gain of 0.34%. Moving on to the sector's performance today, leading the pack at number 1 and capturing the gold medal, consumer cyclicals. At number 2 for the silver, technology. At number 3 for the bronze, communication services. Meanwhile, the laggards of the day led by utilities, healthcare, and consumer defensives. What about the advance to decline ratios? NYSE 48% advancing versus 49% declining. The Nasdaq 42% advancing versus 54% declining. What does that mean? The Nasdaq is leading the gains in the indices today, yet by 42% advancing. It means that the rally in the Nasdaq was on the back of the rise of certain big cap technology names, namely Facebook today. Moving on to the futures market, what's going on here? The dollar is stable, so we're not seeing massive moves in the futures market based on swings from the US dollar. Instead, we're seeing certain commodities moving up or down based on the technicals of the charts. For example, when we talk about crude oil prices, pretty much stable for the day, but we're seeing massive downside for natural gas prices. And we talked about natural gas a few days ago, and I pointed out the bearishness on the charts for you. For example, this is a 1-hour chart, and last time we went over the chart, I pointed out for you the double top formation followed by double bear flags, which is yet another indicator of a massive loss in the positive momentum. And therefore, since then, natural gas has traded down. From a daily chart perspective, natural gas formed a head and shoulder formation indicating that we have more downside to come here for natural gas. But before you celebrate, understand that we have support, solid support at around $4.70, and the likelihood is natural gas prices could catch support from that particular level. Another point to understand is, if the winter season forecast comes out indicating that temperatures will be lower than expectations, the natural gas prices will surge to higher highs. Another energy commodity that we have to pay attention to is coal, because coal prices are surging out of whack, specifically Chinese coal prices. And this is of course spilling over into certain commodities and other stocks here in the US market related to coal. For example, we have the stock of Peabody surging significantly higher, over double digits today alone. And here is the chart of the stock. The ticker, of course, is BTU. We have a defined trend. The chart went down, revisited the trend once again, made a higher high in a bull flag formation. The bull flag is playing out, and now it is about to face the resistance of the former highs in or around 19.8. The likelihood is, even if we have a pullback here, this stock will surge higher, surpassing the former highs because the momentum remains extremely strong. It is actually just starting to pick up steam. Moving on to grains, let's see what's going on here. Corn futures leading the gains in grains by a little over 1% today, followed by soybean oil. I remain long soybean oil. I'm not sure when I shared the chart of soybean oil with you, but here's an update. I bought soybean oil contracts in expectations that the triangle consolidation pattern will be broken to the upside. And this is exactly what we're seeing for now, and I see more upside to come for soybean oil prices. We also had gains for canola, soybean meal, wheat, soybean, and oats futures today. On the other hand, rough rice futures closing at the flat line. What about meats? We have gains for lean hogs. Meanwhile, live and feeder cattle futures closing in the red today. What about metals? Down day across the board. Gold down, copper down, silver down, platinum down, palladium down, everything is down, even though the dollar is stable for now. So is the action in metals predicting another pop in the US dollar? Certainly something you want to keep in mind. because a pop in the US dollar once again will slow down the so-called rebound in the stock market, if not reverse it. Lastly, what about softs? We have modest gains for cocoa futures. Meanwhile, declines for cotton, coffee, lumber, sugar, OJ, all trading down. We have massive declines day after day, week after week for OJ futures. So with this inflation raging out of whack, we have the silver lining here. Let them eat OJ. Moving on to the big casino, the options market. What's going on here? Leading the pack at number 1 with about 1.1 million contracts, Apple. About 71% of those were calls. And at number 2, Tesla, the souffle, with about 875,000 contracts. About 60% of those were calls. Notice the shift in sentiment, by the way. They were buying puts aggressively last week. They lost, and now they're waving the white flag. And we're seeing more call options buying from Tesla bulls, anticipating that the stock will rise to all-time highs, if not surpass all-time highs. To me, this is a signal, a contrarian indicator that Tesla is about to top once again. But here it is at number 3, AMD, with about 600,000 contracts traded hands today. About 70% of those were calls. I'm noticing, of course, AMC. We pointed out the bullishness on the charts. They're buying more and more call options here, perhaps prompting a gamma squeeze. I'm also watching Facebook, a name that I still own calls on. I'll give you an update on the call options trade that I shared with you a few days ago, last week. I tweeted this, indicating that I'm buying Facebook calls, and I believe on October 13th, the video that I released on October 13th, I covered the chart of Facebook, indicating why I'm buying calls on Facebook. Hint, it is due to oversold technical conditions. But also, when you look at the implied volatility and you study the implied volatility, it was surging higher, pretty much topping on puts, indicating extreme bearish sentiment. On the other hand, the implied volatility for calls dropped like a rock. This is usually a contrarian indicator that the stock is about to bottom and rebound higher, and this is exactly what we're playing here. And here is the options grid for the call options that I bought with the expiration date October 29th, which will be, by the way, the week when Facebook reports earnings, and therefore the options premiums are highly elevated. You look at the implied volatility is surging higher, about 33.45. The historic volatility is around 32, and I believe that the implied volatility will continue to rise higher and higher and higher, lifting those premiums also higher and higher and higher. Now, I bought the 330 calls last week for about $8. They are now trading at around $13.50 a piece. So the trade is already profitable. But remember this, I tell you over and over and over again, pretty much in every single video, when it comes to the success of any options trade, 50% is dependent on the construction of the trade. 40% is dependent on the management of the trade, and 10% is dependent on luck. If you are constructing your trades depending on 90% luck, then you're doing it wrong. If you are depending on 50% construction, 40% management, and 10% luck, the majority of your trades will be profitable. We're done with the construction. I bought the 330 calls. Now they're in the money. We move on to the management part of the trade. How do you manage the trade to ensure its profitability? Here's what I did today, and bear with me, by the way. If this is not clear, if I'm going too fast, pause the video, grab a pen and paper, a tablet, whatever you like, look at the options grid, and do the calculation for yourself. This is, of course, a hypothetical example. I'm not giving you the trade exactly as I did it. I'm just giving you a hypothetical example close enough to the trade that I have right now. Let's say that I bought the 330 calls at $8 a piece. You buy options in contracts, of course. Each contract has 100 options. Therefore, you multiply 8 by 100 and then the quantity of contracts that you bought. Let's say, for example, I bought 10 contracts. All in all, I'm spending $8,000 on this trade alone. Let's say that I closed 4 contracts out of the 10 today at the price of $13 a piece, and I received $5,200 as proceeds from closing these contracts. Now, I'm left with 6 contracts, and I'm turning those into a call spread. By selling 6 contracts contracts of the 350 calls and receiving $5 apiece. You multiply 6. These are the number of contracts that I have, and I opened spreads on them. The 350 calls, of course. I received $5 apiece. Each contract has 100 options, so you multiply all of that by 100 once again, and you get $3,000 raised from the credit received from selling those calls. The 350, you sold 6 contracts. Each one has 100 options, and each option is priced at around $5. You get the $3,000. Now, the original investment is $8,000. So far, you sold 4 contracts at $13 apiece. You got $5,200. And you raised an additional $3,000 from selling 6 contracts of the 350, turning your trade into a call spread. All in all, you received $8,200. Minus your original investment, the principal of $8,000, now you're sitting on $200 profits. If Facebook crashes tomorrow and it goes down to $250 a share, it's over, the trade is gone, but are you losing money? No, you're not. You're keeping the $200 profit, meaning you're getting paid to trade right now. You don't care where the stock is going to go. In the best case scenario, holding all the way till expiration, for example, let's say the stock surges higher, earnings are good, whatever it is, it doesn't matter, and the stock closes at 350 and above. Your maximum profit is, remember, the ceiling is 350 because you sold 6 contracts of the 350. You still own 6 contracts of the 330. This is a $20 difference. You multiply this by 100 because you have each contract containing 100 options each. You have 6 of those. All in all, assuming Facebook closes above 350, by the expiration date, you're going to collect $12,000 plus the $200 that you raised from selling the 4 contracts at $13 and then raising credit from selling 6 contracts of the 350. All in all, your maximum profit is $12,200. And again, I'm not saying that I did this exactly the same way, but it is the same strategy. Now, if you're not familiar with options, and this is outer space language for you, it's okay. You can pause the video, do the exercise once again on your own, and you will get to the same conclusion. It will become easier for you to understand how to manage these trades. You don't want to open trades and just sit on them without management, without changing the structure once in a while to ensure the profitability of the trade. Anyhow, folks, we're moving on to the unusual activities that took place in the options market today. Starting with the ticker NIO for NEO. They're buying calls here, the 43 calls for the expiration date, October 29th, with the expectations that the name will pop higher by more than 9% by then, and they paid about 38 cents apiece to enter this trade. All in all, spending about $1.4 million. What about the trade for the ticker NTES for NetEase? They were buying calls aggressively for this name, but somebody is calling a top here by buying the 85 puts for the expiration date, November 12th. With the expectations that the name will drop down by more than 13% or so, they paid about 90 cents apiece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker BIDU Baidu? They're buying calls here on these Chinese names, not just NEO, but also for Baidu. The 180 calls for the expiration date, October 29th, with the expectations that the name will pop higher by more than 5% by then, and they paid about $2 apiece to enter this trade. All in all, spending about $2.5 million. What about the trade for the ticker SNAP Snapchat? The name is reporting earnings this week. They're buying protection here. These 65 puts for the expiration date this upcoming Friday, October 22nd, with the expectations that SNAP Snapchat could drop by more than 14.5% by then, and they paid about 50 cents apiece to enter this trade. All in all, spending about $600,000. What about the trade for the ticker UAL United Airlines? Also reporting earnings tomorrow. We will look at the earnings preview by the end of the video. They're buying protection again, the 44 puts for the expiration date, October 22nd, with expectations that the name could drop down by more than 7% or so by then. They paid about 18 cents apiece to enter this trade. All in all, spending about $200,000. What about the trade for the ticker MU Micron? They're buying puts here, expecting more pain to come for the name. They bought the 63 puts for the expiration date November 19th, with expectations that the name could drop down by more than 6% or so, and they paid about 75 cents apiece to enter this trade. All in all, spending about $800,000. Lastly, what about the trade for the ticker AFRM, Affirm? They're buying calls again, the 170 calls for the expiration date this upcoming Friday, October 22nd, with expectations that the name could pop higher by more than 8% or so by then, and they paid about $2.20 apiece to enter this trade. All in all, spending about $2 million. Moving on to the heat map analysis, let's see what's going on here. Of course, the obvious, we have a sell-off in the healthcare sector of the market. Likewise, we have a sell-off in REITs and utilities. What does that say? REITs and utilities trade higher when yields trade down. If we're seeing a sell-off in utilities and REITs and even consumer defensives, the market is saying that yields have not topped yet, and the rally in the 10-year yield is just starting. We have another pop coming. What does that mean for the names that are lighting up green on the screen right now? The big cap technology names, the high momentum, high growth names. These are also names that suffer when interest rates rise higher. So is this the market's way to say that interest rates are about to pop higher again and therefore abandon utilities, REITs, and perhaps the big cap technology names, the growth and momentum names? It could be. My reading for now is we are seeing some short covering in technology, the big caps, the momentum names as we head into earnings. But the reading of the market that interest rates have not topped yet, I believe that, and I think that interest rates will continue to pop higher. We haven't seen the end of the rally in the 10-year Treasury yield. This will not be good for tech, but it will be good for financials, banks, regionals. It doesn't matter, all the financials will do pretty good if interest rates continue to rise higher. Moving on to charts, starting with the SPY 30 minutes chart. What's going on here? We started the day with a gap down, yet the dip was bought right away. The momentum remains extremely strong here, and the dip in the morning did not fix the stretched, overbought conditions on the 30. What does that mean? We're waiting and waiting and waiting for the pullback. I believe that we're getting closer here for the pullback. The SPY already closed the gap. It is trading above 447, the resistance. Now support. The likelihood is the chart will start to pull down and consolidate in the days to come. Most likely between the range of support at 443 and the resistance at 447. Of course, we're waiting for earnings. Earnings will determine, will the chart climb even higher to all-time highs, or will we see the resumption of the sell-off? Moving on to a daily chart for the continuous contract for the SPY. Again, the momentum indicators remain strong. They're popping higher in positive territory once again. The volume is receding. All of these are good signs for the bulls. The problem is you're not going to go in a straight line all the way to all-time highs. We're getting stretched here from an intraday perspective. What does that mean? It means a pullback, but there is no damage yet on the daily. The daily chart remains intact, but you're not going to see this pop continuing in a straight line. You're going to stop, or we're getting closer and closer to the stop here. Perhaps revisiting 4,384.5 for support and then bouncing higher. Moving on to the Qs 30 minutes chart. This is even more comical here because the Qs gapped down in the morning, yet the dip was bought right away, and now the chart looks funny. It has been melting up higher and higher and higher on low volume, and now it is trading above 372, which was resistance, now support. It already closed the gap at around 372, which was the destination from the algorithmic buying. What happens now? After this massive algorithmic rebound higher, we're about to see a flush down. We're not talking about a crash here. We're not talking about the resumption of selling yet. We're talking about a pullback, but the pullback will be a little aggressive in the Qs versus the SPY, and it could take us all the way down to the support of 369 before the chart consolidates away the earnings from big cap technology names. And therefore, I'm closing the majority of calls when it comes to the Qs and the technology bets, with the exception of Facebook, of course. We already talked about that. And I'm switching to puts once again. And what am I expecting, by the way? This is important for you, specifically the bears. I am anticipating a pullback, not a crash, not a resumption of the selling. Therefore, if you're being too aggressive with your shorts, buying puts way out of the money with shorter expiration date or buying SQQ's calls way out of the money, then you're probably going to lose your money. We're expecting a pullback, not a crash. Tune your expectations in trading accordingly and be reasonable. You're not going to see massive moves right away here as we head into earnings. The market will not crash before we get earnings from the big cap technology names. And lastly, look at the RSI, severely overbought here from a 30 minutes perspective. Again, we're anticipating a pullback. We're waiting for a pullback. We're betting on a pullback. And here was the daily chart for the continuous contract for the Qs. The chart struggled overnight to break above 15,192, went down all the way almost to the support of 15,000, reigniting the coil before springing higher once again and closing the day above 15,192. It is now facing another resistance at around the shoulder line of the head and shoulder formation, which will most likely stop this vertical line higher, the rebound. We will pause and consolidate from that point on. The momentum indicators remain strong, nothing wrong here. If anything, they are bullish. Likewise, the receding volume is yet another bullish signal. You're not going to see a sell-off, the resumption of the sell-off, massive down days without the volume picking up higher. What is the catalyst for the selling volume to pick up higher? Bad earnings? Certainly could be. Moving on to the IWM, this remains the concerning weak link within the charts. The SPY, the Nasdaq, all trading higher. For some reason, the IWM is struggling. And as I told you, we have a lot of technicians here who believe that the IWM is a leading indicator. If the IWM is a leading indicator, it is forming a bear flag and it is struggling to rally higher. In most likelihood, the chart will flush down to the support of 223. And if that is the case, and the IWM is a leading indicator that we're about to see a pullback in the SPY and the Qs. Although I have some disagreements here of assuming that the IWM is a leading indicator, I believe that we are in a rotational market, meaning the IWM cooling off and we see the Nasdaq surging higher. And the opposite is true. If the Nasdaq pulls back, the IWM outperforms. We will see which assumption is right or wrong in the next few days. Is it those assuming that the IWM is a leading indicator, or is it those who believe that we have a rotational market between the IWM and the Qs? Moving on to the Dixie, the dollar index, what's going on here? Still holding the support above 93.7. The problem is it is consolidating in a bear flag formation, indicating that a break of the support of 93.7 is perhaps imminent. If the dollar doesn't pop higher by, say, tomorrow, the likelihood is the bear flag will play out and the support will be lost. A retreat in the US dollar means a rally in commodities. A rally in commodities means higher inflation. Higher inflation means higher interest rates on the 10-year yield. Put two and two together, the inflation trade of industrials, oil, energy, materials, financials look a lot better than the deflation trade of technology, growth, and momentum. And here is the chart of gold. What's going on here? Gold is no good. You gotta avoid it. It's not happening. Three enemies, lots of problems. The Dixie, yields, Bitcoin, until and unless all three go down, the dollar, the 10-year yield, and Bitcoin, gold is no good here. And the likelihood is the Fibonacci support will be broken. The ultimate destination will be at around 1,685. Here's a chart of the 10-year yield, and again, we're watching and we're waiting for a top. It appears that the dollar is weakening, but it doesn't appear that the 10-year yield is weakening at all. Until and unless the support of 1.5% is broken, we don't have a top here in yields. And the chart, the assumption should be that the chart will go higher and higher and higher. And therefore, you have to trade and place your investments accordingly. Higher interest rates are good for financials. They're not so good for tech. And by the way, the Fed says we're not lifting interest rates higher anytime soon. The substantial further progress test is much more stringent when it comes to interest rates vis-a-vis tapering. This is bullshit, of course, and market bettors, the speculators, are betting that the Fed will be forced to raise interest rates sooner than they want. And here is a chart of the TLT weekly chart. What's going on here? It is positive for now, but we have negative divergence on both the RSI and the MACD indicators. What does that mean? It means that the momentum for the TLT from a weekly chart perspective is shifting from bullish to bearish. What does that mean? Yields will continue to pop higher. And here's a 4 hours chart for the VIX. What's going on? We had a pop in the morning. This produced the dip that we saw in the SPY and the Qs. The dip was bought and the VIX retreated right away. Notice on the 4 hours chart, we did not have a crossing on the MACD indicator. Without a crossing, a positive crossing, you cannot assume that the pop in the VIX is sustainable and assume that the drop in the SPY and the Qs will not be bought. What are we seeing right now? We had the pop and the drop, and the MACD indicator is curling upward. It is just a matter of time before we see a pop higher, a crossing, creating positive impressions on the histogram of the MACD, which will come hand in hand with a pop in the VIX, perhaps going all the way to the resistance of 20, and this will produce a pullback in the SPY and the Qs. Moving on to Apple, what's going on here from a daily chart perspective? The MACD indicator is looking good, curling to positive territory once again. We have a higher low. We have the chart trading above 145. The ultimate test will be closing the week above 145. Again, the chart could pull back, but remember, you're not going to see a massive move one way or the other, specifically to the downside, without hearing the earnings report from Apple first. Of course, the company came out with new products today, the XDR, Retina Liquid, X Max, just threw a bunch of buzzwords, and the sheepies will buy. Tim Apple, of course, goes out and does the acting thing, pretending that this is a Bond movie. We don't need all of that. Just show us the products and wrap it up already. But these stunts from Tim Apple cost the company millions and millions and millions of dollars just to produce some stupidity and feed his ego. But we also have bad news for the iMob because they fired an employee, an activist employee. And here's the headline from the Washington Post. Apple fires employee who raised awareness of workplace misconduct allegations at the company. These are all the woke tech companies who try to lecture us what's right and what's wrong, and they shame everybody at the slightest mistake. But it is a glass house. They're throwing stones from a glass house. We have misconduct allegations not just from Apple, but for Google, Facebook, all of these big cap technology names. But what do they do, by the way? Do they listen and say, you know what, thank you. Thank you for bringing up the misconduct allegations to make us aware? No, they don't do that. They fire and punish the employees. They bully their employees. If you speak up and if you shed any light about any misconduct or wrongdoing from our side, we're going to punish you and fire you. And we will make sure that you will never get a job in this industry again. These companies are pure evil. These tech companies, they are the definition of evil. Moving on to Tesla, the souffle 30 minutes chart. What's going on here? Popping higher, the squeeze continues, but we are reaching obscene and excessive levels. When you look at the momentum indicators from a 30 minutes perspective, the MACD, the RSI, all extended right now. This is not a signal to sell, but it is a sell zone. It is a short zone. And therefore, I initiated a put option spread here, a calendar spread in anticipation of earnings. Now bear in mind that the daily chart remains positive. It is reaching and eyeing all-time highs. But look at where the RSI is trading right now. It is trading at the same levels from which the chart of the souffle pulled back before. And of course, everybody's eyeing all-time highs. The bulls are eyeing surpassing all-time highs. The bears are eyeing the double top formation. The likelihood is we're going to have buy the rumor, sell the news ahead of earnings. And therefore, I have some trade ideas here for you. For the bears, I have a calendar put spread. You're playing earnings, of course. Tesla will report earnings, I believe, tomorrow. And therefore, this is what we're going to do right now. Tesla will report earnings on Wednesday. But here's a trade idea. You're buying a put calendar spread, the 800 put, with the expiration date October 29th. You're also selling the 800 puts, the expiration of this upcoming Friday, October 22nd. All in all, the trade is costing you $4 a piece. If this is too much, you can buy the 750 spread, similar structure, pretty much identical. You're buying the 750 for the October 29th expiration, and you're selling the 750 for the October 22nd expiration. All in all, you're spending about $2.75 a piece. And the bet here is that Tesla will pull back in response to earnings, but it will not close below 800 by the end of the week if you're buying the 800 spread, or below 750 if you're buying the 750 spread. But you are expecting that Tesla will pull closer to that number by next week. Now, I also have a trade for the bulls, Tesla longs, but remember, you gotta have 100 shares minimum of the stock to follow this trade. In essence, the trade is an insurance policy. You're selling an upside call, exploiting the elevated premiums for out-of-the-money calls as the stock continues to grind its way higher and higher and higher. You're using the proceeds from selling those calls to buy puts. In this case, you are selling the 900 calls for the expiration date this upcoming Friday, October 22nd. And you are receiving about $9 a piece. You're using some of that money to buy the 800 puts for the expiration date this upcoming Friday, October 22nd. And you are spending about $4.50 a piece to buy those. All in all, you are receiving credit of $4.50. What's not to like in the structure, right? You're receiving $4.50 a piece to protect your investment from downside. Now assume that Tesla, after earnings, pulls down, but it doesn't close the week below 800. That doesn't matter. You win. You received $4.50 a piece in credit. If the stock drops below 800, those 800 puts will appreciate in value, and you could receive more than the $450 per contract that you receive. You could actually make more gains as the stock slides down. On the other hand, what happens if the stock pops higher after earnings, closing the week above 900? The worst case scenario here is you're going to have to sell your shares for $900 a piece, assuming that you bought them at 600, 500, 700, 800, doesn't matter. Is it really that bad if you sell your shares at profit and you can buy them right back? Now, if you're not comfortable with the 900 calls and you want to move it up a little bit, you can do that. You can sell the 920 or the 950, doesn't matter. The idea remains the same. You're selling an upside call out of the money. You're using the proceeds to buy out of the money puts, which will protect you if the stock goes down. Anyhow, we're moving on to BTC. What's going on here in tulips? We're waiting and waiting and waiting for the ETF. The problem is, once again, I assume that we're going to see the buy the rumor, sell the news phenomenon. And this is an exchange of hands between the dip buyers who already scored big. They bought the dip at 40,000, 42,000, 50,000, and now they're sitting on massive gains. They're booking profits and passing the bag to who? The FOMO crowd, who are betting that Bitcoin will pop higher and go to all-time highs, etc., etc. That could happen, but it's a lot of risk here. The buying should have happened when everybody was bearish, including me, by the way, at around 40, 42,000. This is the time to book profits. Moving on to AMC, what's going on here from a 30 minutes perspective? Popping higher. We have yet another bull flag. What are they eyeing, by the way? They're eyeing the gap at around 44, and they will close the gap. It's just a matter of time here. When we switch to a daily chart perspective, again, the MACD indicator, we have a lot of repair. The momentum is positive again, and it is just moving higher, meaning we still have higher highs to come. The problem is, will the momentum be enough to get the chart all the way to all-time highs, or at least the recent highs from the squeeze top? I doubt it, but I think we have higher highs. The chart could top again at around 55, 54, and then trend down again. You got to continue to watch the options grid for AMC because this is, once again, an options trading driven stock. Without buying calls, the stock doesn't move higher. Moving on to the conclusion of this video, let's start with earnings previews. What do we have on the earnings calendar tomorrow? We have Johnson & Johnson in the morning, and then we have Procter & Gamble, followed by United Airlines, Ulta Beauty, and the big one, Netflix. Let's do some of those. We're going to skip Johnson & Johnson because this stock doesn't move one way or the other due to earnings. All eyes will be in the vaccine. The assumption is that after the problems, we have a lot of hesitancy regarding the J&J vaccine as people favor the FDA-approved Pfizer. But when it comes to Procter & Gamble, this is an important name because we are in this inflationary environment. How much and how far can Procter & Gamble stretch their muscles by jacking up prices higher for consumers? This is taking from the last report. As you can see, we have different segments for the business. The year-over-year growth in the net income, the net earnings for certain segments was actually negative year over year last quarter, specifically for the fabric and home care and the baby, feminine, and family care segments. Are we going to see an improvement now year over year as prices move higher? On the other hand, what about the beauty, grooming, and healthcare segments? Last quarter, they had a positive rate of growth year over year when it comes to net earnings. But again, will these margins be squeezed further Or did Procter & Gamble jack up prices higher in the last quarter and the consumers responded positively? If that is the case, then the margins will improve. If not, the margins will get worse, specifically in the beauty business. I shared with you retail spending last month, and it actually went down for beauty and personal care. So this is a sign for concern when it comes to Procter & Gamble. Likewise, to begin with, their gross and operating margins were already shrinking year over year. They went from 49.5% in 2020 to 48.3% in 2021 for the gross margin last quarter. Likewise, for operating margin, it went down from 19.7 to 18.7 this year last quarter. The question is, when will Procter & Gamble flex their muscles by jacking up prices higher? The answer could be they already did that, and we will see improvement in margins. This is what I'm watching for in Procter & Gamble's earnings. Moving on to United Airlines, once again, as you might already know, I am bearish airlines. And the reason is I'm looking for aircraft fuel. Last quarter, the cost of aircraft fuel went up over 400% year over year for United. Likewise, and this is an important one, for aircraft maintenance and repair, you and I already aware of the labor problem, the labor shortages pushing wages higher. We're also aware with material costs surging out of whack. Last time around, aircraft maintenance cost went higher by 174.5% year over year. Likewise, the distribution expenses went higher by almost 350% year over year last quarter. These are massive numbers. The expenses for airlines are growing higher and higher and higher. The silver lining last quarter was the growth in revenue. Passenger revenue went higher by over 540% year over year. And this, of course, will compensated the increase in expenses. The problem this quarter is we saw the rise of Delta, and therefore my expectations are the passenger revenue actually went down. When we talk about the growth rate, you're not going to see increases of over 540% year over year. That's the top. On the other hand, what you might see is an increase in aircraft fuel expenses, aircraft maintenance, and material outside repairs. All of these categories could surge even higher. If aircraft fuels move higher year over year from 413% to say 500%, now we're getting into a massive problem for these airlines. The revenue is going down. Meanwhile, expenses are surging higher. This is not a good combination here, and I remain bearish on this name. What about Ulta Beauty? What's going on here? We're not going to look at last year's numbers. That's an outlier. We know what's going on here. Stores were shut down, etc., etc., etc. We're looking at the numbers this year in comparison with 2019 numbers. In this case, the company is still growing, be it at a slower pace. I used to own the name, not anymore. The problem is the chart is already trading out of whack. It is desperately begging for a pullback, and I think we will see the pullback after earnings, and the reason is, as I shared with you last night, retail spending, specifically in the health, beauty, and personal care segment, is actually down. It continues to go down as people stayed at home during the Delta wave. Lastly, what about the big one? Netflix, what's going on here? Everybody's watching Netflix. Netflix has massive moves after earnings, up or down, but these moves are quickly erased in the next few days. What we're watching for here is the paid net membership additions or losses. As you can see, in pretty much every single region in the world, when the pandemic hit and everybody stayed at home, these numbers surged higher, but they continued to move down and down and down as the pandemic eased. Matter of fact, the numbers went to negative, meaning Netflix was losing accounts last quarter, at least in the United States and Canada. So we are watching this number. What is the assumption here? We had the Delta wave. Everybody stayed at home. This is the assumption, of course, that people stayed at home, and therefore the assumption is we will see the paid subscribers for Netflix growing once again. What if the number is actually shrinking regardless of the Delta wave? This will be really bad news for the company, and therefore we will see a massive reaction to the downside. On the other hand, if the number comes out impressive, assuming that everybody stayed at home during the Delta wave, pushing the paid subscribers numbers for Netflix higher, then the stock could react by a pop higher. Because again, when you look at other FANG names, they're all trading out of whack when it comes to valuations. Google, Facebook, Apple, Microsoft. The cheapest name is Netflix. It is not growing at the same rate as, say, Facebook, but it is still growing, and therefore it could be undervalued. It depends on what the number is going to be. And this is what I'm watching for in Netflix's earnings. We're also watching for the corporate response to the walkout from trans employees and the firing of other employees on sharing secret information allegations. I mean, the whole thing is weird. We need more clarity from management tomorrow. Lastly, moving on to the economic calendar, what's going on here? We don't have anything important besides building permits and housing starts. These are all important for the housing market, yet the leading indicators not looking good. You saw what happened with Zillow today. Zillow is pretty much waving the white flag. The market is too expensive. It is about to head into stagnation. Prices are too high. Nobody can afford these houses. The building expenses for home builders are surging higher and higher and higher. So this is a market that is already heading into stagflation. Anyhow, folks, this is all I got for you for now, but I will talk to you again tomorrow. Thank you for watching, and thank you for listening. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.